Today, we will talk about top 10 dividend stocks to buy. The Federal Reserve has made a dramatic move to raise interest rates and tighten liquidity as part of its efforts to rein in inflation. After having held interest rates at or near zero for the greater part of the past decade, the effective federal funds rate has now topped 5%. In August, the surge in interest rates has accelerated. Average 30-year mortgage rates have reached 7.5% nationally, and yields on long-term government bonds continue to rise. 1. ExxonMobil Corp. XOM. ExxonMobil is a dominant integrated oil major. It has operations spanning much of the globe covering oil, gas, refining, and chemicals. This diversity of assets and geographic positioning has allowed Exxon to perform well despite a rocky pricing environment for oil and gas over the past decade. Notably, Exxon didn't cut its dividend during the 2020 oil price crash, even as most of its peers greatly reduced their dividend payouts. Income investors can sleep well at night because Exxon has one of the world's strongest balance sheets. Exxon also continues to invest in growth. For example, its offshore oil field in Guyana has been one of the biggest discoveries in the industry since the turn of the century. During a time when many energy companies have pulled back on oil, Exxon has continued advancing its business and paving the way for rising dividends for decades to come. 2. Coca-Cola Co. KO. One of Warren Buffett's all-time greatest investments has been his firm's position in Coca-Cola. Berkshire Hathaway Incorporated, BRKB, started buying shares in the soft drink giant following the stock market crash of 1987. Berkshire has held shares loyally over the decades and has been rewarded with countless billions of dollars in capital gains and dividends as a result. 3. Pfizer Incorporated, PFE. Pharmaceutical giant Pfizer has gotten caught in a tailspin. The company saw its business reach record heights during the pandemic as its COVID-19 vaccine generated tens of billions of dollars in revenue. Investors have been bracing for the end of that revenue stream, but a recent uptick in COVID-19 cases may cause renewed interest in the vaccines. Even discounting future vaccine revenues, Pfizer is in a better place now than in 2019. Analysts project that the company will bring in $67 billion in revenue next year. That's light years ahead of 2019's $41 billion. 4. Wells Fargo & Co. DOFC. Many investors still have Wells Fargo in the penalty box. After all, the company became infamous for its fake accounts scandals in the late 2010s. Wells Fargo paid heavy fines and its reputation suffered as a result, but there was an unexpected silver lining. The Federal Reserve placed an asset cap on Wells Fargo as punishment for its misdeeds. This kept Wells Fargo from deploying as much capital as its peers in the early 2020s, and the bank didn't load up on the low interest rate securities and loans that sunk smaller rivals such as First Republic and Signature Bancorp. 5. Verizon Communications Incorporated, VZ. Verizon is one of the three dominant U.S. wireless carriers. Investors have long counted on these blue-chip stocks for steady income streams. Rival AT&T Incorporated, T, shocked investors with a dividend cut in the aftermath of its ill-fated Time Warner acquisition. And while Verizon is in better shape than AT&T, the industry faces rising competition and high costs from 5G network rollouts. For Verizon, though, it's at the peak of its capital spending cycle now, with management anticipating a significant improvement in its cash flows starting in 2024. 6. American Tower Corp. AMT. As one of Verizon's landlords, American Tower operates as a real estate investment trust, or REIT, and controls more than 226,000 communication sites. These are primarily cell phone towers, but also some other assets such as data centers. Many REITs have tumbled over the past year for two primary reasons. One is that investors are demanding higher dividend yields as the rates on low-risk, fixed-income instruments rise. Another is that REITs will pay more interest on their debts as rates increase. However, things are getting blown out of proportion. American Tower stock has lost about a third of its value over the past year on these worries. That leaves the stock at less than 18 times forward funds from operations, or FFO, and offering its highest dividend yield in 5 years. 7. TC Energy Corp. TRP. TC Energy is one of Canada's largest energy companies. It is primarily known for its US and Canadian oil and gas pipelines. However, the firm is broadly diversified. TC Energy has a large power generation business based around low-cost nuclear energy. TC's investments in Mexican gas pipelines are seeing considerable success as Mexico goes through a rapid wave of industrialization. 8. National Storage Affiliates Trust, NSA. Storage REITs are another area that is under fire from rising interest rates. Even with a wave of mergers and acquisitions across the sector this year, the publicly traded storage REITs are hitting fresh 52-week lows week after week. That sets up a compelling opportunity for income investors. National Storage Affiliates is one of the industry's best growth stories. Founded in 2013, it has already grown to generate more than $800 million in annual revenues. Its shares had seen steady appreciation since its IPO in 2015, but have declined since the start of 2022. Over the past year, the stock is down about 35%, even with decent underlying earnings results. Shares now sell for just 12 times FFO and offer a 6.7% dividend. 9. Kimberly-Clark Corp., KMB. Kimberly-Clark is America's leading consumer paper products company. It offers a wide range of toiletries, cleaning products, and other assorted goods. The stock briefly spiked in the early days of the pandemic as folks stocked up on essentials. Shares plunged in 2022, however, amid a sales slowdown combined with a surge in commodity prices that hit the company's profit margins. However, things are lining up nicely for Kimberly-Clark going forward. Sales are returning to normal and the inflationary wave has started to subside, giving the company relief on that front as well. Shares are up just 10% over the past 5 years and are down slightly from where they were heading into 2020. This has created a relative value in KMB stock today, with shares at about 21 times forward earnings and offering a 3.7% dividend yield. 10. Grupo Aeroportuario del Pacífico S.A.B. de CV, PAC. Pacific Airport Group, as the name translates, is a Mexican airport operator. It runs 12 airports in Mexico and 2 in Jamaica. Prized concessions include the big city of Guadalajara, industrial hub Tijuana, and beach resorts such as Puerto Vallarta and Los Cabos. Concessions for the Mexican airports run until 2048 and can potentially be renewed for an additional 50 years. Mexican tourism has been booming in recent years, and that has been reflected in the airport's results. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.